Hello everyone and welcome back to Stock Navigators Option Series Chapter 4. In this video we will talk about the theta or the time decay factor associated with options. So a brief review. In the previous week, in Chapter 2 we talked about the delta and the gamma. In Chapter 3 we talked about the vega and the implied volatility of options. And in today's video we will go over theta, the fourth Greeks that are very important to options trading. So let's get into it. So what is theta? Theta describes the sensitivity of an option theoretical value to the passage of time. It is expressed as a number of points that are lost from 1 day from time decay. The long option position will have a negative theta, and a short option will have a positive theta. And we will talk about this, the relationship between the buyer and seller in the next video. So the most important concepts for beginning option trader to understand is theta, because as time goes by, the value of your contract will be decreased. So the theta basically explains the effect of time on the premium of the option that have been purchased or sold. So the less time that an option has until expiration, the faster that option is going to lose its value. So let's go into some demonstrations to help you understand the concept of theta. So this is an example of how time decay will increase rapidly in the last 30 days of an option. So let's say if you purchase an option that is 120 days out until expiration. So as each day goes by, the time decay will subtract some money or some value from the premium of your option. But this speed is not a linear speed, or it's not like a constant slope where each day go by, you lose a fixed amount of money. But the time decays is most likely a parabolic curve where the last 30 days of an option is where the time decays is the most rapid, and the last week of an option is when the time decay will completely destroy the premium or the value of your option if if the underlying stock price doesn't stay above the strike price if you buy call, or if the strike price does not stay below your strike price if you buy put. So we will get into that later. For example, I'm looking at Tesla. Maybe I'm picking a contract expired 3 months from now on March 18th of 2022. So let's say I pick the strike price at the money. So Tesla is trading around $1,003 right now. So if I pick the option $1,000 strike price with the price of $142.75 per share, so that translates into $14,275 per contract, and that amount is reflected in this number over here as your maximum loss. So meaning if by the expiration date the Tesla price does not move up above $1,000 or above your break-even point, then most likely the time decay will completely subtract this whole amount of $14,275 from your option. So if you look at the theta column, on average as of now, every day you will lose about $70 for the time decay, and that amount is also reflected here in this box of showing the theta number. So when we go to analyze this option, the single buy call $1,000 strike price on Tesla expired March 18th 2022. So if you look at the left column here, that is the theoretical value of your option at each expiration date, and the expiration date can be found on these four curves on my screen. So if you look at the top right corner, the white curve represent the value of this option as of today, and the blue curve is the value of this option by January 21st, 2022. The green curve represents the value of this option by February 23rd next year, and finally the red curve represents the value of this option by expiration date, March 18, 2022. So again, the theta as of right now is showing over here as $70 per day on average. You're losing this amount every day. And to demonstrate the effect of time decay, so let's say by January 21st, 2022, if the price of Tesla does not move at all and it stays still at this current price, $1,000, then the time decay subtract the money from your options. So now you are in a loss of about $4,000. And similarly, as time goes by, so let's say the price of Tesla keep going sideways, it does not increase or decrease at all. So by February 23rd, the price of your option now is decreased again, and it's now you are in the loss of around $8,000 now. And finally, by expiration date, which is the red curve at the bottom here, if Tesla doesn't move at all, then the time decay will just completely subtract the money from your premium, and you will now be in the maximum loss of $14,000. And even if Tesla start moving up, let's say up to $1,060 price level, but because of the time decay, by January 21st, in order for you to break even, then Tesla has to move up to this level around $1,060. And again, let's say by the expiration date, if you want your option to not losing the whole amount, then Tesla price has to move up to around $1,143 just for you to break even. So looking at this curve, you can tell how time decay will affect the value of your option at each day and each different strike price, price level of the underlying stock. So on this screen, we will look at the curve that represents the value of the theta at each expiration day as well. So let's say, again, the white curve represents the theta as of now, which means on average from now until the end of the month, you may lose on average about $70 per day. And by January 21st, you will lose about $94 per day, which is the blue curve. And as you can tell, the last 30 days of the option, which is February 23rd, which is the green curve, the time decay just work rapidly, and on average, you will lose about $150 per day on this option. So this is the end of this video. If you like what we're doing, please give it a like, subscribe, and you will get notified when we post new lessons. Thank you for watching.